Good evening, everyone, and Happy New Year to you. Thank you for tuning in tonight, as I just want to spend just a few minutes of your time and talk about what's going to be the most popular personal finance subject that people will be focused on at the beginning of, or the first quarter of 2017, and that is taxes. If you've tuned in to my personal finance call a few weeks ago, or if you subscribe to my YouTube channel, I've taught you that the average person puts about 25 cents out of every dollar they earn towards taxes. Yet, it's usually the last thing people think about regarding finance, especially if you're an employee. Until around this time, because coming January, you're looking forward to getting that W-2, file your taxes, and get that huge refund, right? But I want to change your mindset just a little bit to give you a better understanding of how taxes work so you can increase your income for the coming year and become a happy taxpayer. I know that sounds weird, but just follow me here. If you look at the wealthy or successful households, come April 15th, you'll find that they're not looking forward to a tax refund come in. Why? Because they're not getting a refund. Instead, they're paying in taxes for the previous year. And it's usually because they didn't pay enough taxes, or if they're business owners because taxes weren't due yet unless they're set up on these pre-tax payments. And people usually see that as a bad thing, but if you switch it around, you can actually see it as a good thing, which means they maximized or they over-maximized the income that they've earned over the previous year, so they could put that income towards something better. Now, if you're looking forward to a tax refund for 2017, that simply means that you overpaid taxes. Now that I can look at as a bad thing, because you simply just gave the government a free loan of your hard-earned money for them to work with, and then you're getting your money back, hence the term refund, a year later, a few months later. Now, if you look at it that way, that means you basically gave them an interest-free loan, and if you calculate inflation into this, then you basically lost money on that money that you gave to them. So the whole goal is when you file your taxes is to file at net zero, which means you didn't owe and you don't have to pay any more. So basically over the course of the 12 months of 2016 or now coming into 2017, you paid enough in taxes. So to help you understand how to do that, you want to understand how taxes are calculated. So if you follow on the 1040 form, the tax form, or whatever type of form that you file, a lot of things are done online these days, so you don't have to do the whole calculation. But I want to give you a quick little background on it so you know how they're calculated, and therefore you can go in and calculate those taxes and determine how to get to a net zero. So the first thing you look for in the filing of your taxes is the adjusted gross income, which is simply just the gross income that you've earned minus any contributions that you've made to your retirement, any student loan payments, health savings accounts payments, and so forth. And that will give you your adjusted gross income. Then once you have that, you can look and calculate your taxable income. Your taxable income is simply your adjusted gross income minus any exemptions or deductions you have. Now you want to be careful about how many deductions that you claim, because if you're looking to grow within the next couple of years, for example in real estate, you'll see that banks are going to look at your taxable income. I remember hearing a story about a business owner who earned a really great income and was looking to invest in some real estate. So as she started the application process, turned in her tax returns, the bank ended up qualifying her for a $500 a month mortgage. I'm not sure what type of home you're going to get on a $500 a month mortgage, but it's because she claimed too many deductions that significantly reduced her taxable income. So you want to be careful about how many deductions you claim. Then once you figure that out, then you can calculate your tax liability. You can go to the IRS government website and see the chart of how taxes are calculated. You'll see that it's progressive tax. So one tax you're going to pay, your first part of your money is going to go towards one percentage, and the remaining is going to go to the percentage tax bracket you fall in. So to help you understand it better, I'm basically just going to take the average 25% tax bracket earner and using a taxable income of about $40,000. So if your taxable income is around $40,000, the amount of tax you're going to pay is $5,183 for the first $37,650 that you earned. Then the remaining amount is going to be taxed at 25%, which gives you a total amount of $5,750. And then here's where you want to take advantage if you want to minimize your tax liability, is the tax credits. That's fuel efficient cars, electric cars. I believe they're still giving tax credit for those. Solar panels still have some tax credits going on. Child tax credits, earned income credits, so forth. So you want to speak with your accountant or CPA and find out what type of tax credits you qualify for. So I hope that gives you a better understanding of how taxes work. So as you prepare for 2017, you can go in on your W-4 form if you're an employee, adjust your exemptions, speak with your accountant to see how you can maximize your income for 2017. You're not paying too much or too little for the government, and then you can start living more with purpose. So thank you for tuning in tonight. God bless and Happy New Year.
I just wanna